Thanks for joining us. I'm Marlon Bowling, your tour guide to the ag commodities. I'm joined now by Brian Hoops of Midwest Market Solutions in Springfield, Missouri. How's the weather today there, Brian?
Hey, things are rainy in Springfield. Iowa's a little sunshine, so things are starting to look up, but kind of a wet forecast for the rest of the week.
Okay, is that going to have an impact on the grain trade? Let's take a look at how we're opening up here this morning. On the corn market first, we have that July contract trading kind of like it did overnight, about 2 lower at 447 3/4. September down 3.5. The new crop December down 4.5 at 458.5. So it hasn't really changed much from its overnight trade. On the soybean market, we are a little lower there too. We have July down 4. We're at 909.5, and now you have November down 4.5 at 935 3/4. Onto the wheat, a lot of pressure continuing in the wheat market. It's been a tough week on the wheat market. We have July in Chicago down 7. We're at 524.5, and in Kansas City we're down there too. July currently down 7 3/4 at 457.5. And in Minneapolis wheat, your spring wheat trade, we have July down 10 1/4 this morning at 542. What catches your attention here this morning on the start of the grain trade?
Yeah, we are a little bit lower here overnight, but so far in corn and soybeans, we've held yesterday's lows. So we have an inside day going. A lot of times that means a little bit of a consolidation type pattern. And so that's not necessarily a bad thing, can lead to a very big move at some point down the road. And I know a lot of producers are hoping that we move back to the upside in corn and beans. The forecast is what the markets are trading off of. They're looking at the weather wet this week, but then by next week, more of a ridging pattern starting to develop, heat moving in from the south, and that initially should be bearish for prices and positive for yield potential, unless that ridge sets in and maintains throughout the balance of the summer. We may see these markets react in a negative fashion because of warmer and drier weather, which is really what we need. So you've got that acreage report at the end of next week. That's going to be a major market mover. A lot of uncertainty about how many acres will be planted to both corn and soybeans, and yield potential will be the next major driving factor on corn and soybean value. So there's a lot of moving pieces coming here. Markets right now just kind of taking that consolidation approach.
Okay, so you were talking about the fact that it looks pretty wet through the end of the week, and that would get us out into, well, past the 20th of the month already. By the time things would dry out enough to plant, you're probably talking early to mid next week in a lot of areas where they still haven't got their soybeans planted. You get into the last month of June for your planting on soybeans. Yes, you can get them in, but in effect, it's almost like putting in double crop beans in a lot of areas.
Yeah, exactly right. It is at the time frame where you're going to be putting in some double crop soybeans, and they always yield a little bit less. If you have a really good growing season through the summer and into the fall, you can have a decent yield, and that's really what we're going to need. And the market, the soybean market, has put in a little bit of a premium here, coming off of its lows into the summer by nearly $1, trying to give that farmer an incentive economically to go ahead and plant it, even if there is a little bit of a yield loss. But we have a big enough balance sheet that we can absorb some yield loss. We can absorb some soybeans not being seeded, but you still have to grow a decent crop to meet the demand that we have.
Okay, Brian, we'll come back and take a look at how we're opening up in our cattle and hog market action on Wednesday as well. We'll come back talking more with Brian Hoops after this. We're talking with Brian Hoops, and he is with Midwest Market Solutions, and he's based in Springfield, Missouri. As we transition over into our livestock segment here, I have kind of a bridge topic here, if you will, Brian. We were talking about the fact that the wheat market is having some struggles, but at the same time, it's kind of mirroring what's going on with the feed grain component of corn. And you said there could be a correlation between a couple of contracts there, and you might explain that as we get into our cattle discussion here.
Yeah, we can talk about cattle. We talk about the price of feed inputs, and one market that's really going to be affected is the wheat market. We're going to have a pretty high yield potential for the winter wheat crop, especially in Kansas City, but the protein levels are down, and that means we won't be able to export very much of that wheat. We're going to have to go into the feed rations, and so especially in the southern plains, you could see a lot of this wheat being moved into cattle feeding regions. December corn price, $4.59. You've got Kansas City December price around $4.90, $4.89. So, there's a price relationship there that at some point that wheat will will move into the feed rations unless it stays high enough relative to the corn market. So it's certainly something that we expect will happen going into the fall. Egypt has tendered for wheat overnight, and the U.S. did not even offer any wheat because we're not competitively priced on the world market.
When you look at the cattle prices right now, I do see a weaker tone developing here on live cattle. So a closer look reveals that we have that August contract right now, 22 lower at 105.33, and you have October down 27. It's at 106.78. On the feeder cattle side, more of the same the way it seems. We have August down 25 at 137 even per hundredweight, and the September contract down 30 cents at 137.30 per hundred. Lean hog trade, though, is kind of bucking the trend here and going the other direction, at least in the early going. July is up 20 cents. We're at 81.67. August lean hogs now 83 higher at 82.53. That's the biggest gainer of the bunch here in the lean hogs. October up 70 cents. So even though the cattle market is lower today, they are still hanging on to those contract lows that were posted a couple of weeks ago, and it looks like they're fairly stable, doesn't it?
Yeah, it does. Getting some support out of the southern plains where it's expected to be extremely hot by the weekend. We may see some cash cattle breaking loose ahead of that heat moving in. Otherwise, you're looking at cattle and feed report on Friday being the major market mover. We've come off of our lows that were charted earlier this summer. And those futures markets probably going to respect those lows and hold them both in the live and in the feeder cattle markets. Just the direction will be coming from the cash markets this week. If we can kind of stabilize and move higher, that'll be a confirmation that the summer lows are in.
And it's kind of interesting that we do have the cattle on feed report coming out this Friday, and we have a cold storage report that won't come out the same day. It'll come out next Monday, I guess, and that could have a little impact too, right?
Yeah, it certainly could. And, it's good that we don't have them on the same days. That way we can kind of react to that information individually, so to speak. So I think it's a good thing. We'll react to the cattle on feed reports, see the numbers there. We do expect placements to be down significantly from last year and last month, and that should be a positive factor for those deferred cattle.
All right, thanks, Brian. Brian Hoops of Midwest Market Solutions in Springfield, Missouri. Janet, that's how we're opening up. We'll see if things change next half hour.
All right, as always, thanks for getting things started, Marlon.